Datadog is trading at $123.31 right now, which is a jump of 5.39% just today. It is a fascinating move because if you've been watching the headlines this morning, you probably saw TD Cowen lowering their price target on the stock. Usually, when a major firm trims their target, you expect the price to sag or at least stay flat, but we are seeing the exact opposite. The market is effectively looking past the lowered target and focusing on the underlying demand for observability. This gap between what the analysts are saying on paper and how the actual price is reacting creates a massive curiosity loop for anyone trying to figure out where the next leg of this trend is going. It's easy to look at the chart and think this is just a relief rally, especially since the stock has been under a bit of pressure lately. But there is something much more structural happening beneath the surface that most casual traders are missing entirely. The common expectation among retail investors right now is that the high-growth cloud sector is starting to hit a wall. You hear it on social media and see it on various investing sites where people are worried that the massive gains we saw in names like Nvidia stock or even Apple stock are going to lead to a broader cooling off in software as a service. The reality, however, is that as companies move more of their operations to the cloud, they cannot afford to stop monitoring those systems. Datadog is not a discretionary expense for a tech firm, it is the central nervous system. When you look at the recent daily swings, we are seeing a lot of volume coming back into the name after a period of consolidation. While the broader indices might be choppy, the institutional activity suggests that the big players are using these dips as a way to build larger positions. If you open up the Robinhood app or check your Fidelity mobile app, you'll see that the trading volume for Datadog is significantly higher than its 30-day average today. That tells us this 5.39% move is not just a fluke or a low-volume spike, it is a conviction move. It's interesting to see how this compares to other high-beta stocks. For instance, while Tesla stock might be moving on headlines related to government policy or production numbers, Datadog moves on the fundamental health of the internet itself. Every time a major bank or a retail giant moves their data to a hybrid cloud environment, the need for a tool that can see across all those different silos becomes essential. This is why we are seeing such a strong reaction today, despite the cautious notes from certain analysts. Comment below how many shares of Datadog you currently hold or if you are waiting for a better entry point. It's always helpful to see where the community stands on these high-growth tech names. When we look at institutional activity, the picture gets even more interesting. Recent filings show that firms like Allstate Corp have been picking up new positions in the hundreds of thousands of dollars, and heavyweights like Geode Capital and Invesco have been adding millions of shares to their portfolios. This is a clear signal that professional wealth management teams and those using platforms like Schwab Intelligent Portfolios are seeing value here that the average person might overlook. However, we have to talk about the elephant in the room, which is the insider selling. We've seen the CEO and the CTO selling significant chunks of their holdings over the last few months. In the world of online investing, seeing the founders take chips off the table can be a major red flag, but the reality is often more nuanced. These are often scheduled sales or part of a diversification strategy. The question is whether the institutional buying can outweigh the pressure from these insider liquidations. For the person who likes self-investing, the technical setup on the Fidelity trading platform right now looks like a classic breakout from a falling wedge. We have seen a series of lower highs and lower lows over the last few weeks, which has frustrated a lot of bulls. But today's price action is breaking that cycle. If you were using an interactive broker's account to trade the technicals, you probably noticed that we just cleared a key resistance level near the $118 mark. That level had been a ceiling for several sessions, and now that we've blown through it with 5% plus momentum, that old resistance might become new support. This shift in sentiment is exactly what keeps people glued to their screens when they invest online. Looking at the business model itself, Datadog provides a platform that integrates infrastructure monitoring, application performance monitoring, and log management. Think of it as a massive dashboard that shows a company exactly where their software is breaking. If an e-commerce site goes down, they lose money every second. Datadog helps them find the bug in minutes rather than hours. This is why their retention rates remain so high. They've been expanding into the security space as well, trying to capture more of the budget that usually goes to specialized cyber firms. Their recent acquisition of Metaplane shows they're doubling down on data observability, making sure that the actual information flowing through the pipes is accurate and not just that the pipes themselves are working. The macroeconomic pressure is the biggest risk factor here. If interest rates stay higher for longer, it puts a squeeze on the valuations of companies that trade at high multiples of their earnings. Datadog is not cheap by any traditional metric. If you're looking at your SoFi active investing dashboard, you might see a price-to-earnings ratio that looks astronomical compared to a legacy company. But in the world of cloud monitoring, you are paying for the growth and the dominance of the market. The expectation is that they will eventually grow into that valuation, but the reality is that any slight miss in their quarterly reports can lead to a 10 or 20% drop overnight. This is the tightrope that investors walk when they choose to hold individual brokerage positions instead of just sticking with Fidelity ETFs or a broader index fund. We're heading into a very busy few weeks for this stock. They have their fourth quarter earnings call scheduled for February 10th and then an investor day just 2 days later on February 12th. This is a massive 1-2 punch that will likely determine the direction of the stock for the rest of the year. Usually, when a company schedules an investor day so close to an earnings report, it means they have a lot to say about their future roadmap. They want to capitalize on the attention of the earnings report to explain their long-term vision. This could be where they show off more of their AI integration features or perhaps announce a major new partnership. Traders using the Interactive Brokers platform will be watching those dates very closely for any hints of guidance raises. If you are using Robinhood stock trading for quick moves, you have to be aware of the volatility that these events bring. We have seen in the past that Datadog can jump 18% on a good report, as it did back in November, or it can slide just as quickly if the guidance for the next year is even slightly conservative. The market is currently pricing in a lot of optimism, which is why we are seeing this $123.31 price point today. The tension between the high expectations for the February meetings and the reality of the global cloud spending slowdown is where the opportunity and the risk live. Many people are looking for investment help because they are torn between the long-term potential of the technology and the short-term noise of the market. Whether you are using the SoFi trading platform to build a small position or managing a complex portfolio via Fidelity Wealth Management, the key is to understand that Datadog is a bet on the complexity of modern software. The more complex systems get, the more they need Datadog. It's a virtuous cycle for the company. They are not just selling a product, they are selling a solution to a problem that is only getting bigger. Even with the competition from companies like Dynatrace or New Relic, Datadog has managed to maintain a lead in terms of ease of use and the breadth of their integrations. They have over 900 different technologies they can plug into, which makes them very hard to replace once a company has fully integrated them into their workflow. As we look at the broader sector, the momentum in software has been trailing behind the hardware giants like NVIDIA for a while, but we are starting to see a rotation. Investors are looking for the next place where the AI spending will show up in the bottom line. The logic is that once everyone has the chips and the servers, they will need the software to monitor and secure the applications they are building. This is where the story for Datadog gets very compelling. If they can prove that they are an essential part of the AI stack, their valuation might actually start to look reasonable again. This is the kind of insight that separates the successful self-investing crowd from those who just follow the crowd on social media. The online investing landscape has changed significantly in the last couple of years, with fractional shares on the Robinhood app and the ease of using a SoFi robo-advisor. More people than ever have exposure to these high-growth tech names. But having exposure and having an actual strategy are two different things. It's important to look at your individual brokerage accounts and see if you are over-leveraged in one sector. If your portfolio is nothing but cloud software and AI chips, a bad day for the Nasdaq can be devastating. That's why many people use Fidelity mutual funds or diverse Fidelity IRAs to balance out the high-risk plays like DDOG. In summary, what we are seeing today with the move to $123.31 is a classic case of the market rejecting a negative analyst narrative. The 5.39% gain is a sign of strength that contradicts the lowered price targets from the big banks. The expectation was that the target cut would lead to a sell-off, but the reality is that buyers are stepping in because they see the long-term value and the upcoming catalysts in February. We have discussed the institutional support from firms like Allstate, the technical breakout seen